Welcome back to Trade and Wait. Today we're going to review price action on the ES chart and outline some trade setups utilizing ICT concepts, internal range, external range, vice versa, back and forth, and utilizing the 4-hour time frame as our high time frame chart. That's to discount the premium, identifying the daily range. Kind of going off the top of my head because I don't want to be here long on these charts, and I want to have fun while I do it. So, very often, having a plan is important. Sticking to the plan is perhaps even more important. I think I mentioned on previous videos that what I am focusing on this particular quarter is reducing. I wish I could say eliminating, but that's not something that's realistic. But placing guardrails in place to prevent myself from putting on impulsive trades. Impulsive trades, as we define it, is trades that either you don't have a trading plan for, or you deviate it from the trading plan. And part of that also includes like fat finger errors, putting on too much size. That obviously that's deviated from the plan. Fat finger errors is like, hey, I intended to put buy one contract, but I bought 3 accidentally, so to speak. That's going to cost you, right? Another possibility is, let's say you go short and you're looking to exit that trade. You need to buy back. Those that contract instead of selling the contract. So that type of mind game, if you're not ready to like press the right button or press what you need to press to collapse the trade, you may actually just end up adding to your position. This is the quote like I like to bring up. I'm gonna say the quote like I want to say it. Whatever. If you find yourself in a fair fight, you failed to plan. That's how it goes. You failed to plan properly. And that's for a fair fight. So step your game up. Stop playing with your life, your money, or your life. Get down and lay down, right? Anyway, today was Thursday, 8:30. Am I tripping? Today was Wednesday. I'm about to take a shower and go to sleep, so I don't know. Anyway, that's TMI, too much information. I'm not editing that out, so enjoy. Whatever. It's going, how the night comes before the day. I'm not going to justify slip of the tongue, but whatever. We had FOMC meeting minutes at 2 p.m. and Commander-in-Chief spoke at 5 o'clock. There's that. And what I want to focus on today, I'm always doing something, right? Let's see. It did have these quotes. Insights. If you treat the 4-hour, you notice these handles are different, but this is like a previous one. He closed this one and created this one during the mentorship, 2022 mentorship, but whatever. If you treat the 4-hour or 1 hour, 60-minute chart as your daily chart, as your AKA higher time frame chart, and study the 5-minute structure, a whole new world opens to you. Test it and see. It doesn't mean that you don't have to trade in the direction of the hourly time frame. Or I didn't mean the hourly, but trade in the direction of the daily or the weekly time frame. But you can treat it like you treat your daily chart, utilizing the 4-hour or 1 hour. Right? It's very easy to like identify weekly levels on the 4-hour chart. It's very easy to identify daily levels on the 60-minute chart. That's just a side note. You don't even have to utilize what I just said also. You can also trade candles, right? A lot of people trade like the 10 a.m. candle for like futures, 10 a.m. candle. I wish I can tell you to remind me. Maybe I'll throw that in there. But if I forget, pardon me, excuse me, because I don't want to make this video too long. And this is something I need to do for myself as much as I need to do it for you guys. but also the 15-minute chart removes the blur, right? So that to me is, all right, if these other time frames, high time frames, are not clear and not clear to you, then keep dropping down. That also changes your identity. Whatever time frame you utilize to identify your trade setup, that's also going to determine what type of trader you are at that time, and also what type of targets you're gonna put in your scope, right? It affects your entry, affects your targets, and it affects your stop loss, right? Your risk to reward ratio, your R, your percent R, however you want to see it. So yeah, in general, I don't necessarily look for multiples of R, but I do by trading standard deviations. But even along with that is what aligns with market structure. So anyway, 4-hour chart. I'm gonna clear all this out and just do it over. But the 4-hour chart, it looks like a consolidation. Looks like a consolidation. And this looks like a market maker buy model, right? And this is the original consolidation. Here's your smart money reversal. Here's your low risk buy and targeting these relative equal highs. But that's the 15-minute chart. That's a side note for now. All right, we are 6 minutes and 40 some odd seconds into this video. Let's low-key, let's wrap this up, right? And this is what I mean by these each whatever color these little things are. This delineates a new week. And this is what I mean, right? So this is a 4-hour chart, but you can clearly see the weekly levels because this is a weekly high. This is a weekly high. This is a weekly low, etc. Right? So you can see here that we are kind of flirting around this previous week's high, right? Kind of consolidating around the previous week's high. And if you don't like that previous week's high, you can go all the way back here and say we're flirting around this week's high, right? January 24th, which is aka the previous month's high, right? So we're flirting around the previous month's high, and we are about a week and a half before the conclusion of this month. So so that tells you right now that we ran the previous month's high. And you look at it in terms of the formation of the power of 3, then we kind of opened here, right? Kind of open here. We pull down here. So this is your open, your low. Right now, this is your high, and we're looking to see where we close. So we already ran, the previous month's high, January's high. Anyway, that's all extra. That's not what I intended to speak about, but it's like a write-in, right? They say, hey, only write about what you know about, right? So also trade what you see. Don't trade what you don't see. So that's what I saw, so I spoke on it, right? Let's clear this up. And all right, so those lines that you saw, and you can see here, this is where we are right now. And we can see that we are right now is an inside day. We're inside the previous day's range, right? This is still Wednesday. The day's not over. All right, so we have an inside day, but whatever, right? All right, let's get to it. All right, so you don't have to do this, but I did this initially to say, okay, what is going on in terms of trend lines, right? You can do that, right? 1, 2, in this case, 1, 2, 3, and then we want to see what price does when it reaches here, and here it broke out and traded back in. So that's one way of looking at that. and also again to the downside. And I 1, 2, this is a low. Technically it's a low on this candle, broke below that low, ran stops here, pull back in. So again, it did it here. You can even tighten it up a little if you want to do like 3 points of contact. So that's 1, 2, 3. So we see the range technically that price is trading in. That's a side note. That's not even like, if you want to do that, do it, right? It doesn't really matter, right? I'm gonna leave it there. Maybe make it like, make it light, because not, it's useful information for whoever it's useful for. It's not something that you have to do. But in this case, we're going to highlight this 4-hour fair value gap. If I can spell, right? 4-hour fair value gap. Why did I highlight this fair value gap as opposed to this one? It's because of this. Come on, man. I want to make a smiley face. What are you playing? Disrespect is real. All right, let me get rid of that. Have a little fun, man. What's this without fun, right? But anyway, let's just do this. Just because of this. 1. Because of that. And you see price react to it, right? So this is, as you say, this is a key level. This is a key fair value gap. So you have that one, and you have other ones, right? You have this too, right? It's reacting to it. You have this one also, technically that reacted to it. This one also reacted to like the consequent encroachment as well. And then you have this one and this one, right? 4, 5. I'm gonna delete all of these again, but just so you can see it, it's there, right? And let's say that's not clear. He's probably saying like, oh, they didn't do consequent encroachment and all this and that. That's okay too. I'm not here to prove anything right. I'm just here to see, ideally, man, we all doing this for a reason. We all doing this so you can, do what we got to do, right? So anyway, so we can see the quarter mark, right? Didn't quite get down there, but you see, how does the saying go? The bodies tell the stories, but the wicks do the damage. So the bodies are just respecting the quarter level, and then eventually it respects the high of the fair value gap. Anyway, that's that. That's why I chose that. That's the rationale. So you go, oh, this is internal range liquidity. Why? Because it's inside of a range, inside of the range. Then we do this here. This would be your external range liquidity. Previous swing highs and swing lows. So in this case, this would end right here. So we're gonna call it external range liquidity. And it's also sell side, buy side liquidity. And shots like, all right, and then do the same thing here. So this is actually relative equal highs here. And you see price ran above it. Likewise, here is also relative equal highs again, because you have this here. But so yeah, you can denote that as relative equal highs if you want. I'm just going to leave it as it is. External range liquidity, buy side liquidity. Likewise here would be sell side liquidity. You can see sell side liquidity is rated. And you could also say that's order pairing, right? So besides that, you have order pairing, right? You have, so what am I talking about here? What am I talking about here? So you have internal range liquidity here. Can I do this to like right here? Boom, right? So you have that one, internal range, and then it's targeting the swing high, targeting external range here. That's a shallow run above. So technically it ran here, consolidated below this level, then finally broke out. So there's your rate on external range liquidity here. Right, so that's that one. To here. So that's your external range liquidity is rated. So now where should price go? Back to internal range liquidity. So let's change these to like a green or something, just a different color. So back to internal range liquidity. So there you go, internal range liquidity here. Now where should price go? External range liquidity. It kind of failed here. Ran up, it failed. Again, retreat. It's one thing again, well, again, I like to say again, like I said it before, but the bodies tell the stories and the wicks do the damage. Also, another key element is that the bodies of the candle have the bulk of the volume. Bodies of the candle have the bulk of the volume. One of the PD arrays, I think it's I think it's a rejection block. I'm not very versed in rejection blocks. I treat wicks like gaps. And that idea I just mentioned just now, that the bulk of the volume is in the bodies of the candles, not the wicks. Doesn't mean that the wicks doesn't have volume, but clearly you can see with your eyes that the bodies of the candles are thicker than the wicks. So whatever. It's like very simple statement, but it means a lot to me. So anyway, so you have here price ran this right here. So we can go, okay, that's external range liquidity, right? External range liquidity. So again, internal range to external, ran above these highs here. Ran above these, the bodies of the candles here. Back to internal range liquidity again. Internal range, come on. So that's internal range, and then where should price go now? Back to external range, back up here, back above, because obviously, all right, that was that one. You could just point it out. And then this one targeted all of this actually. Right, so that's boom, right? So again, probably took longer explaining something that simple, but I wanted to make sure that's clear, right? Internal range, external range, shallow, consolidating below potential resistance, break above, so external range liquidity rated, pull back down into internal range liquidity, same fair value gap. Bodies of the candles, bulk of the volume, rejection block review into that, traded into this wick here. So it's a failure swing. There's no break in market structure to the downside too, by the way. Right? There's no break in market structure, so it's still bullish, right? So that's why we have it's a consolidation, but it's like we have here, there's an upward trend. still trading in the range as we define the range from the range high and the range low. So that's that. So internal, external, internal, external. I'm wilding now, so don't quote me. Just go back a couple of minutes and it'll be easier. I just don't. It's like ping pong to me. Like, oh, did this, did that, did this, did that, did this, did that. And sometimes it gets a little convoluted. So I think I did a great job of explaining this in this situation. So maybe I should leave it at that, right? Stop being so so extra, right? There's a tiny little fair value gap here as well. There's one here as well that was violated, and then there's a little one right here that price is kind of playing with right now, and that's that one. It's that tiny one there. So so we can say external range, internal range. And that'll be kind of sick if it goes here and goes external range again here. But we'll see, right? Because this is actually a balanced price range here. Because you have this bearish one, you have this bearish one, and you have this bullish one. So this range here is a key range. So we had drop here. You have this inverted fair value gap, if you want to call it that, at this moment. And you have this bullish fair value gap, which makes this a balanced price range. So ideally, price should be targeting this swing high here. And this is a 4-hour chart. That's just something. Don't quote me if I mess up. Quote me if I get it right. But whatever, it doesn't matter, right? Doesn't matter, right? All right, I can't resist it. Clickety clink, clickety clink. The money goes into my piggity bank. That's how it goes, right? Anyway, couldn't resist. Had to say it. So from there, 4-hour chart is complete. So now we have 4-hour levels. We have 4-hour levels and 4-hour targets. We have 4-hour draw on liquidity, internal, external, like that. And we can drop down to like a 1 hour if that's what suits you. Look for entry model. Or we can go to the 15-minute because the 4-hour and the 15-minute are very, very compatible. This trades here. I'm gonna just 22 minutes in. We can talk about today's price action. All right, yesterday. So I was looking at yesterday and the Asia session at 6 o'clock. I jumped the gun though. I jumped the gun because this is what anyway, this is not the topic of discussion, but this is me. I had to do my playbook for yesterday or today, technically. I saw this here and I pulled that back. Obviously, this wasn't here, so I'm gonna delete that. So I seen this breaker, high, low, higher, high, and I said, "Oh, price should be going down, right?" And the stop loss would have been here at the high at that time, high of day, Tuesday. Let's put the try to keep the chart less busy. So the one that the indicator normally separates the days for me, but I didn't put it on the 1 hour, so I'm gonna just do it now. All right, so there you go. So I only use this one at the time as the breaker, and this is the 1800. So I entered right here. I entered this swing high, and I had my stop here. And my ideal was for price to fill this fair value gap But actually I was plotting on the 5-minute, so real fast. I was actually looking for price to, so this was the entry, this was the stop loss up here, and I was looking for price to trade below this consolidation and then this consolidation. So I didn't even consider, I didn't even look at it like, oh, price is going to fill this imbalance here. It was literally price is going to trade below this the entry, trade below this consolidation, and then trade below this consolidation. You got a tiny little fair value gap here. You can see price, this area is sensitive already because you have this price failure consolidating here anyway, which is probably this potential order block. It didn't break anything here though. Anyway, you can see stab here, stab here, stab down, stab down. So this area is sensitive. There you go. But also this is the 4-hour fair value gap here. Kind of jumping the gun, but this was my logic for the short yesterday or this morning. I entered here literally 6 o'clock as soon as I seen it drop in here. Then it wasn't an impulsive trade. It was a logic-based trade. However, it wasn't a time-based trade. So whether all this drawdown, I collapsed the trade. I collapsed the trade like once I seen it hold above here, only because I didn't want to accept. Now it's a 1-hour time frame setup, so that's literally for me. The stop loss is still up here. It was a good trade still. It would have been a profitable trade still, even though I would have taken some drawdown. So technically, this would have been the complete breaker block, and you can see price reacting to it. And let's see this candle open and the high the same, 61.56.50. And I want to see what this 61.56.25. So not bad. Oh yeah, pretty much the bodies of the candles respected this breaker block. There you go, the short below the bodies of the candles didn't take out the wick. That's okay. So it's a 1-hour time frame based trade setup, 1-hour time frame based target, and I like this right here because this is a balanced price range here. You have the bearish fair value gap, and we have a bullish fair value gap overlapping. So all of that is sensitive. Plus we have here price rated, and this is the A+ setup with a long entry here. So we have price rating sell side liquidity here. That's what's the rules? It's like 3 rules, right? I'm gonna type that out again. Rule number 1. What Sunset? Anyway, rule number 1, A+, let me spell it out. A+ trade setup. I'm just playing around though, but rule number 1, wait for run-on stops. Anticipate. Anyway, rule number 1, run-on stops. Rule number 2, your market structure shift. 3, pull back depending on if it's a bearish or bullish setup. Pull back above or below 50% of the range. That caused the market structure shift into a PD array. Yeah. PD array, you're choosing whatever you see, right? So, and that's the entry model. That is all 3 rules. All right, so here you got to run on stops. That's one. Here you have a market. You have the market. You're breaking market structures right here. Let's make that like a 3 or something. Make that like the color you want. Make it that. Here's your market structure shift. And here's your pullback below 50%. Let's see. Pullback below 50% of the range. There you go with that. I think that's pretty clear. But Librium, playing chat. All right. All right, into a PD array. So I'm just looking at this 1 hour time frame. And again, this is a 4 hour. So this is like not even, it's kind of relevant, but I'm trying to like, yo, the same setup is available on the 1 hour time frame, but it's going to show different. So if this 4 hour fair value gap wasn't here, it's still applicable with the running on the order pairing, the running on sell side. And it's applicable here because, like I always bring up, like these fair value gaps to help you identify which ones are like solid. Yeah, you can go down here and say this one here. Let's adjust that. Like that one here. Yeah, that's solid too, right? But you have a balanced price range here, which the bodies of the candles are respecting this. The wicks are doing damage though, but so if you didn't trust this setup, then that's fine too. But your stop loss, he was doing like optimal trade entry long here. Your stop loss is down here. Your stop loss is down here. Apologize. On this time frame. But what I'm talking about as a balanced price range is this. This wasn't even a topic of discussion today, but we got 32 minutes. I'm about to shut this down. But I appreciate y'all. I appreciate the lessons y'all giving me. Anyway, that's that. This is this overlapping range, and I just drew it out just to prove a point. I want to take the middle line off to make it. I leave one on. Anyway. All right. So yeah, that would be a balanced price range. You can see price reacting to these levels over and over. The bodies of the candles respecting these levels. The wicks is kind of like respecting it here after all this damage was done. This was a 2 o'clock candle on Tuesday. Was there anything special going on anything special on Tuesday? Not really. Not really. I wonder what caused this wick down like that. Well, whatever. Ran stops. Doesn't necessarily have to have a fundamental catalyst, but if it did, it would be better, right? So yeah, that would be your support here. This would be, that's this high. actually doesn't show the, yeah, that's this low, this high, 50% of the range into an imbalance. You didn't see that, you didn't see it, it's fine. You still had the 4-hour one here. And if that wasn't part of your setup, let's get rid of this. Oh, I didn't even have to do that. What I could have done is this. Showing me. All right, so that's your optimal trade entry long, using this swing low to this high. Optimal trade entry long entry, optimal trade entry. Let's make that bigger for those in the back. All right, optimal trade entry long 70.5, 61.8, and you target first profit is that swing high, and second target didn't quite get there. However, I might just jump to the 5-minute first just to show. Does it show? Are they playing with? It's not showing. Let's see. All right, there we go. Previous month's high, that's what that is. Previous month's high, we also had the Asia high that wasn't mitigated here. Didn't trade into it until here. So we had the Asia high, or the being targeted, and we had the previous month's high that we refer way back there on the 4-hour chart. All right, so I don't know. So I pretty much stayed on the 4-hour and the 1-hour chart. I didn't intend to do that. Man. All right. So that's that. And that's the trade setup. Here it is right here. It's actually the previous days. You can actually just use the previous day's high, previous day's low, the inside day initially. And let's just readjust that, eyeball that. Still optimal trade entry 70.5. And that's your target. And this is the 15-minute chart. So this looks a lot better than that 1-hour chart. And if you wanted to not include the wicks here for a better model, better entry model, and we could just use the bodies, the highest body. I eyeballed it, so if that's a little off, then do the adjustments yourself. And here you go. Here we have, that's your entry after the Judas swing. That's your entry. Target one hit. Obviously, that's after all the adjustments that we just made. 15-minute chart, 4-hour PD array, 1-hour PD array. Not just whatever's easier for you. You don't have to use that. You don't have to use this either. You don't even have to use, right? Because there's an imbalance right here, a little tiny one. Boom, you got a breaker here too, right? Low, high, lower, low. Here's your breaker. All of this right here. If you don't want to use that, you don't have to. Put it back. Right? So that would be that. You see. All right. So let's say you didn't see that range. So that's the range. Price here is inside this range. 50%, below 50% optimal trade entry. Bam. We also have here run on stops. You have kind of like 1, 2, 3, or 1, 2, 3 reversal pattern. So we have sell side rated here. That's rule number 1. Run on stops. Run on stops followed by what? Breaking market structure shift. Make that like a 2 or something. So you got your market structure shift here. Rallied up. And let's see if rule number 3 applies. What's rule number 3? Pull back below 50% of the range. And there you go. Here's your pullback into this. So that's the setup, but it's like, do you see it? Do you see it? So it's below 50% of the range. If you wanted to see, right? That's the model. That's the model, right? But if you're like me and you're like, hey, I like optimal trade entries. If you would have went for 61.8, you wouldn't have got in like this. But this is up to you. If you don't want to include the wicks, it may work, may not work. But that's the thing. You have to be consistent with whatever your approach is, right? So obviously I didn't expect that to do anything, but you can also do this here, because that's also a swing low right here. And you say, where is the most dynamic price action here? Where's the most dynamic upward price action here? So you wouldn't use this low, right? Because you say, all right, you got two bar, then a pullback. That's actually model two. That's one entry there too, but you could have overlooked it, right? Because it's the breaking market structure on this wick right here. This candle, this swing high, breaking market structure right here. And then this candle is your pullback. And that's into an order block, order breaker right here. This up close candle. Order retest. You can look at this like, right, the retest of this level that was broken. As you can see, prices sweeping below it. So that would have been your entry model. Your first entry would have been off that down close candle. Optimal trade entry long, and almost hit 2 standard deviations. What's time frames? 15 minutes. I don't want it to disappear. I also don't want to make this video too long. Boom. Let's change that to like a 10 so those in the back can see, right? All right, so that would be your entry model here, and that would be 1 standard deviation, almost 2. Again, the long wicks as a model, we don't necessarily have to use the wicks. You have to use the highest high of the 3-bar pattern, which is, this would be the open on this down close candle. Same candle you're going to use to enter. And all right, so there's your model. There's your 3 standard deviations reached. All right, so that's that. What time is that? 10:45. Then you got a volume imbalance. So you could use that too for a model. So you got the order block, volume imbalance. You got a breaker. That's all I see here. You don't like that? You could have. Yeah, that's all I see. Like safely. Like. All right. So let's see. What I was discussing before is, all right. Boom. Right. This big bull bar is stronger than these 2 bull bars. Right. So you gotta put your swing low. Use this swing low to this swing high. And we're gonna adjust it afterwards because we want to see, like, if that is model, if it's consistent, if we can use that consistently, and that's the below 50% of the range, back inside of here still. And let's fine tune it for, and this is a 3-bar pattern. It's your swing low, swing high, it's your swing low or your pivot low. In this case, it's not this body, it's this body. And it's this high. And we have optimal trade entry 61.8, and we almost reached 1 standard deviation. But target 1, target 2 is reached. What else? What else is there? I just identified the 8 session trade in the 1 hour. I identified the bullish run. I actually took a trade this morning. Took a short actually before I got out at 8. Got out at like 8:45, 8:40 because I had to get out of here. It was a momentum scalp. think it was this one here. And trade on the 15-minute. 15-minute. I think I did it on the 5-minute chart. Was it the 15-minute or 5-minute? Definitely was targeting. Yeah, I was targeting this. It's the same trade. It was pretty much the same trade from yesterday, from the 1 hour. Targeting below these this consolidation here. But I got out before. Got out like 8:40, literally 8:40. This is the short I took. All right, let's talk about it. Did I drop down to a 1-minute chart? No, I don't think so. I don't think so. I don't think so. Anyway, let's take this off. Where you going? Where you going? Take that off. Let's take this off, and let's see, right? Because there's a silver bullet between 7 and 8:30, right? 7:30, 7 and 8:30, but it's also an accumulation stage because 9:30 is the manipulation, and then you think about it, like that other silver bullet is kind of like distribution phase, but it's also second stage delivery. Hey yo, slow down, son. Slow down, son. You're killing them. Let me stop. Anyway, here we go here, right? 7:45. That's 7:10. So, yeah, here we go. So we had this right here. We had that. Right? So we had this. Could have seen this as an entry, right? Let's see what the range is. Sure, let's just use this thing here. So it's below, it's about 50% of the range. So that would have been still a good entry into here. And there's no break in market structure yet. But that was a good entry though. And you're using this fair value gap as an entry, you could have put your stop loss above the high right here, or above here, above this, above here. Right? Stop loss here or here, because price could have pulled back into here. That's if you're doing like, that's your model right here. And you could have entered here, pulled back, kind of broke this swing low, and it ran up and ran sell side liquidity here. So run on sell side, then you got to break. So here's your displacement. That's like a rule, right? You need displacement, not just right? This little weak break in market structure here. Displacement. ICT likes to refer to the elephant placing its foot in the swimming pool, like a small kid's pool. Like you're gonna have some, right? A little bit of a splash. So we have this. Now we have a break in market structure here. Break in market structure here. Run on sell side here. Run on sell side here. Break in market structure here. And then you have a retracement. What's the rules? Back above 50% of the range on the price leg that caused a market structure shift. So now you're gonna just fine tune it here. You could have kept that one on, whatever works best for you. But this is the model, right? Run on stops, market structure shift for retracement into an imbalance. And that's actually not just your ordinary bearish imbalance, but also a balanced price range, because you have this here, you have this here, which should add more confluence to your entry, more strength to your entry, to your short entry. So boom, first target, second target, and you're targeting these swing lows over here on this fair value gap. That would have been your third target. And we have one standard deviation. One standard deviation as a target. And if you don't like the wicks, let's see what we can do here. See what that looks like. Another optimal trade entry, and there's your 2 standard deviations. Now go and get, so 2.5 standard deviations, that's awesome. Right, so if your entry is like in here, so let's see, right? Because like I said, you're dealing with standard deviations or portions, right? Here, like whatever. So you do this right here. Let's say 61.8 because you want to make sure you get in. And your stop loss. Let's say your stop loss was above there because this is a stop run. Stop loss is here. And so that right there is a 3 to 1. 3 to 1 based on your entry. Oh, did I do it right? Yeah. Based on your entry to stop loss. 1 standard deviation is a 3 to 1 ratio. 2 to 1, that's your 4 to 8. 4.8. And you want to be like low key, kind of greedy. You're going to say, I'm doing 5. Yeah, you got it. There's your 5 to 1. Easy. And that's even like, this is consolidation. So it's like, I mean, I'm getting out of here, man. Like, I'm a momentum trader. I notice. I like the runaway train type of entries. Can't even lie. Like, I like to see that joint go, man. As soon as I get in, I want it to go, bro. Like, why are you waiting for, man? I got things to do. Like, I got other stuff I want to do. Like, I wouldn't hold on to this probably. I was like, all right, boom. I also saw this here. Let's run back up. I exited here, but then I kept watching. And I think I had this drawn out. Had that drawn out. That was a reason that, as I exited here, pull back, this is a reason to take a second trade, targeting these lows. Then you can keep doing that, right? This is like a order block. Short. Boom. But that's it, man. Like, stick to the rules, man. Stick to the rules. Sometimes you gotta stay in the trenches long enough to realize what works best for you and not what works for everyone else. And sometimes you have to do that while not risking that much or risking anything at all. Right? Gotta learn the rules of engagement before you can engage price. Sometimes you need to just watch, as ICT says, tape reading, like watching price action, having your having like your game plan, like what you're looking for. Like, you don't know order blocks, and don't look for them unless you're learning about them. You don't know breakers, then don't do that. You know, fair value gaps, it looks pretty good. Try it. That's not your thing, then I don't want to misguide you, man, but it may be best for you to throw a little indicator on there, a little 20 EMA and you know, a little, you know, yeah, like all of this. Let's see. This is a 20 EMA. It says Keltner channel. You can do the Keltner channel. 20 EMA. This is confirmation enough for you to stay in the trade. This is also 1 hour 20 EMA on this 5-minute chart, which lets you know, hey, it's still bullish. This pullback, you can look at it as a mean reversion back to value on the 1 hour chart, but utilizing the 5-minute chart. You can do that too. You need to modify stochastic to encourage you to identify, you know, overbought, oversold, or entry models using the anti-pattern, if that's what you're into. And then you can see here that price is holding above the 20 EMA, right? Really sloppy work to like even think about using an indicator. But if you need, there's no judgment, man. Like, clickety clank, clickety clank. The money goes into my piggity bank, right? Now nobody's coming to save you, bro. Or Gil. No one's coming to save you, man. Yeah, this is the 4 types of trades. I told my comrade, my best friend, my brother about this earlier. Trend continuation, trend termination, holding, support and resistance, holding a felon. That's kind of like identifying what's your setup and what type of setups are you anticipating. Anyway, back to it. If you find yourself in a fair fight, you failed to plan. So life ain't fair. Get to it. Your money or your life. Please like, comment, or subscribe to Trading Way. You know, hey, appreciate you. Yeah.